All right, let's jump right in. Have you ever heard of a financial tool so clever it can solve one of the biggest, most annoying headaches in global investing? Well, today we're cracking the code on something called the Quanto Swap. It's a really fascinating solution to a very tricky problem.
But before we get to the answer, you gotta understand the puzzle, right? This is a challenge that pretty much every single person investing across borders has to deal with.
So imagine this. You've done all your homework, you've found an absolutely fantastic company to invest in another country, you're all set to go. But what's that one hidden landmine that can completely blow up your whole strategy, even if you were totally right about the investment itself? This is the part that is just so frustrating. I mean, think about it. You pick a stock in Japan that just soars, say 10%. You're feeling like a genius. But during that same time, the Japanese yen falls 10% against your home currency. And just like that, poof, your brilliant investment call is a total wash. You've made nothing. That's the puzzle we need to solve. And lucky for us, that solution has a name. It's this elegant, really powerful tool that was designed specifically to take that hidden currency risk right off the table. So let's meet the star of our show today, the Quanto Swap. So what is this thing, really? Well, put simply, it's a deal, an agreement that lets two parties swap interest rate payments, kind of like a normal swap, and listen, this is the magic part. It locks in the currency exchange rate from day one. It basically builds a protective wall between your investment returns and the wild, chaotic swings of the currency market. Here's a super simple way to think about it. Imagine you win a big prize at a carnival, but they pay you in these weird carnival tokens. Now, instead of you having to worry about what those tokens are actually going to be worth tomorrow, the owner comes up to you and says, "Hey, don't worry about it. For every token you win, I'll give you $1. Guaranteed." You see? That guarantee, that's the whole idea behind a Quanto swap.
Okay, so we get what it does, but how does it actually, you know, work? Let's break down the mechanics. It's actually more straightforward than you might think.
It all happens in three main steps. First, you've got two parties, let's say a US fund and a big European bank, and they agree on the terms of the deal. Second, they decide to swap interest payments. Maybe the US fund wants to get a piece of European interest rates. And third, and this is the absolute key, all the payments coming from the European bank to the US fund are going to be converted to dollars at a rate they fixed from the very beginning. It doesn't matter what the market does later on. This locked-in rate is the heart of the entire deal. So if they agree on, say, $1.2 for every euro, it makes no difference if the real market rate crashes to 1.1 or skyrockets to 1.3. Nope. For the entire life of their contract, every single calculation uses 1.2. It gives you absolute, rock-solid certainty on the currency front. Now, let's go from theory to the real world, because this isn't just some textbook concept. Quanto swaps have literally saved fortunes during some of the wildest times in financial history. But of course, they aren't without their own risks.
I want you to picture the scene. It's 2008. The global financial system is teetering on the edge of collapse. And in the middle of all this chaos, a really gutsy US hedge fund sees a huge opportunity in European bonds. The risk was massive, not just from the bonds themselves, but from the currency markets, which were in a state of total panic.
You can just imagine the fear in that boardroom. They knew they could make the perfect call, picking exactly the right bonds that would pay out big time, only to see every last cent of those profits get wiped out as the euro just tumbles against the US dollar. The currency risk was every bit as dangerous as the investment risk. And this is where our hero comes in. By using a Quanto swap, the fund locked in their euro to dollar exchange rate. So when the euro did in fact take a nosedive, it didn't matter to them. Their profits were totally shielded, calculated at that pre-agreed rate. The swap turned what could have been a disaster into a calculated, protected win. And it's not just a tool for crisis situations. It's actually super versatile. You've got investors using it to hedge, big corporations using it to manage their financing costs, and even traders using it to speculate on interest rate differences without all that currency noise getting in the way. So what's the catch? Because there's always a catch, right? Well, the benefits are pretty clear. You get to wipe out currency risk, and you can tailor these contracts to your exact needs. But the risks are very real. The biggest one is called counterparty risk. I mean, what happens if the bank on the other side of your deal goes bust and just can't pay you? And this kind of protection, well, it's not free. There's a price for it, a premium that gets baked right into the contract to pay the other side for taking on all that currency risk for you. When you think about it, the Quanto swap is a perfect example of financial innovation that was born out of a real need. It solved this big, messy puzzle of separating an investment's return from its currency's risk. And it just makes you wonder, right? As our markets get even more complex and interconnected, what kind of tools are being invented right now to solve the puzzles of tomorrow?